everyone, and welcome to the Master Series, your guide to intelligent production, brought to you by Entertainment Partners. I'm your host, Natalie Nelson. In the Master Series, we focus on important issues impacting the entertainment industry and its workers through in-depth discussions with legal, tax, payroll, technology, and production experts. And today, our topic is tax considerations for U.S. productions working abroad. And our experts will be diving into compliance requirements that must be met to ensure that crew and talent can easily get paid, whether you're traveling with your production or you're paying U.S. crew working in the UK. For over 46 years, Entertainment Partners has been at the forefront of the industry, and we continually invest to ensure our clients and their productions are successful. As a global leader in entertainment payroll, production finance, and production management solutions, our integrated cloud-based digital solutions support every phase of production. Our established and growing team in the UK specialize in product engineering, customer support, and tax and accounting services. And our US and UK experts, some of whom you will hear from today, offer decades of industry experience and the best guidance in the industry. Two quick housekeeping items as we get started today. First is that we encourage you to join the conversation by posting questions in the Q&A section of the Zoom call. You can do so by clicking the Q&A icon in the Zoom navigation menu, and we'll do our best to save time after the end of our discussion today to answer questions. Also, please take 30 seconds to answer a short feedback survey after today's webinar. This includes the opportunity for you to give us feedback as well as suggest topics for future webinars. Your feedback is very important to us, and 30 seconds is all that we ask. Now I'm pleased to introduce you to today's panelists. Today we are joined by Kristy Carty, Vice President of Payroll at Entertainment Partners. Kristy joined the Entertainment Partners Group in 2022 following its acquisition of Moneypenny Production Accounting. She brings 20 years of UK payroll experience to the Entertainment Partners team and works closely with production accountants, managers, and client companies on a day-to-day basis, sharing her expertise and understanding for the need of flexibility while maintaining accuracy and compliance in the complex circumstances of payroll, film, and TV. Also with us today is Chanchal Panwar, partner of production accounting at FLB Accountants, an Entertainment Partners company. Chanchal is a chartered accountant with over 10 years of experience in the financial services and practice industry, specializing in media and entertainment. She joined FLB after working for one of the largest global financiers in film and television production financing. She became part of the Entertainment Partners team in the UK following the 2022 acquisition of FLB Accountants. And at FLB, Chanchal continues to focus on media and entertainment with specific knowledge in project financing, film financing structures, production accounting, and post-production accounting. And finally, leading today's discussion will be Becky Harshberger, our Vice President and Practice Leader of Payroll Tax here at Entertainment Partners. Becky has an impressive 23 years of experience as a certified payroll professional. She is Vice President of the American Payroll Association Board of Directors. She is a member of the APA National Speakers Bureau, co-chair of the APA Government Affairs Subcommittee on Federal Issues, and in 2020, she was awarded the APA Special Recognition Award for her contributions to the advancement of the payroll profession. She was also named the California Payroll Professional of the Year in 2014. Hello, Becky and Chanchal and Kristy. It is lovely to see you today. Thank you for joining us. I know that we have a lot to get to, so I'm going to pass things over to you. And Becky, how about you kick us off?
Hello and welcome, everybody. Such a great topic for May the 4th be with you.
Indeed. The Star Wars films are a great example of big budget studio features and high-end television shows that are being shot here in the UK.
The UK is booming, right? That's what we keep hearing over here.
We are very busy in the UK. In 2022, the UK high-end TV and feature film investment reached a record 6.3 billion. And I think about 85% of that was inward investment from US studio productions.
And, studio expectations around payroll technology and service levels are high here in the United States, and I think they're high over there as well.
They are, yeah, and that's part of the reason we wanted to do this session today. There's so much that production teams need to consider and think about when they're working on big international productions.
Exactly. When you're filming across multiple jurisdictions, payroll tax compliance can get complicated fast. So we wanted to do a deep dive into the rules and requirements to ensure a smooth production. Before we dive in, Kristy, put our listeners at ease and share how Entertainment Partners can help when it comes to getting cast and crew paid quickly and compliantly in UK productions.
Sure. Entertainment Partners payroll team here in the UK is made up of payroll experts with decades of experience. Through the acquisitions of Moneypenny Production Accounting, Hodgson and Global Entertainment Payroll Services, our payroll team has payrolled over £1 billion worth of production in kind of unscripted, high-end TV and feature films. Some of those being shows you might have heard of: Sex Education, Heartstoppers, Peaky Blinders, Loki 2. And we're totally committed and totally understand the need for excellent customer service at EP UK. Each of our productions will be either given myself or one of my esteemed colleagues, Audrey Gaines or Darryl Knight, will be appointed as a hypercare manager. We'd be there to help you with the setup of your payroll, help you with any questions you might have, and also ensure a smooth running of your payroll ongoing. Our payroll team, fantastic. They're always on hand to answer phone calls, emails, and keep you up to date with the status of your payroll. An added bonus now that we're a global company is that we also work closely with our colleagues in the US in terms of any union payrolls that the productions might have. We'll ensure that that production is set up for processing for the PH&W and deal with the uploads of the information directly with the US teams to ensure the contributions are handled in a timely manner.
It's such a relief to have you guys with us, a global service with world-class support, technology, and expertise. And of course, we recently acquired FLB accountants so that we can help our clients meet their need for qualified, experienced production accountants in the UK.
Thanks, Becky. Yeah, to expand, FLB is a firm of professional accountants with a specialism in media and entertainment. We like to say we can support a UK production from soup to nuts, or in production terms, from development to delivery. Our media team can support producers and productions navigate UK compliance, whether it's Companies House and their reporting requirements on a company level, or HMRC and the UK taxation compliance and navigating VAT. We can support productions with the UK creative industry tax relief, and we can also provide financial support on deal closes for independent or multi-party finance projects. And of course, we provide production and post-production accounting.
Thanks both. Right, shall we get started?
Okay, let's do this. Okay, so we have a question. So let's say you've got a US production that's coming to the UK. How would you go about getting your US cast and crew paid, Becky?
You know, I hate to say it, but it depends. We need as much information in advance as possible. We've researched over 80 countries in the last 15 years.
All right, so maybe we start off with an easy example. It's just a location shoot. You're coming to the UK for a 2-week shoot as part of a larger US-based production, and you're bringing 3 actors and 3 crew.
All right. First thing we do when we're going overseas is to find out if the US has a tax treaty with the country and what it covers. Most tax treaties cover temporary work, Social Security, and Medicare. Many treaties specifically call out actors, live performances, and sports competition. Next, we double check the country's tax code and tax incentive requirements.
So just so I understand, in plain English, what does the tax treaty really cover?
Glad you asked. Basically, the treaties allow a US-based employee to temporarily work in a foreign country while still being paid by the US-based company and not be subject to the employment taxes in the foreign location. The tricky part is the definition of temporary for tax purposes. Temporary is usually less than 186 days, so think roughly 6 months. That said, countries use tax incentives to encourage the industry to come and film there, and in some cases, tax credits are contingent on taxed wages.
You use the term employment taxes. For our listeners, Becky, are you including both income taxes and social taxes in one lump?
Kind of. For Social Security and Medicare, most treaties define temporary assignment as lasting not 186 days, but they go temporary for Medicare and Social Security is about 5 years. But you always have to check the fine print. The US treaty with Italy allows temporary assignments to run an indefinite period of time. just as an example. So in our example of a 2-week shoot location in the UK, the crew are considered employees of a US-based company. Entertainment Partners US would continue to pay the crew as if they had never left the United States, while noting on the time card that the work location is the UK.
You specifically mentioned US-based employee. What about loanouts?
For loanouts heading to a foreign location, there are a few watchouts. First, if the owner of the loanout is subject to a country's taxation because they are working in front of the camera, then they need to be able to pass the tax withholding onto their personal tax return. So knowing the type of loanout becomes critical. An S Corp allows the foreign tax to be passed on to a personal return. A C Corp does not.
So this C corporation can't use the foreign tax to reduce their federal US corporate tax?
Nope, you're right. The tax is kind of trapped at resulting in the C Corp owing taxes on the same income that they've already paid the taxes in the foreign jurisdiction. It's sadly a classic example of double taxation.
Ooh, so to be avoided then at all costs. I guess the mistakes can be made. Is there a way that they can be fixed?
You're making me say that word again. It depends. So to fix this, you have to round up the usual suspects: business affairs, the finance execs at maybe the production, the producer, the production accountant. And in essence, you need to redo the contract or potentially just create an addendum for the foreign work and replace the C Corp with an S Corp. So remember, we're talking after the fact here. So not only do you have to kind of paper it with business affairs and make sure you have all of those documents correct, but then EP also has to move the taxes and earnings to the S Corp, which we can only do during the calendar year. If we find out that we've taxed a C Corp after about December 20th and during a tax year, it's really too late to correct it.
So kind of in addition to that, Becky, what else does a loan out need to be concerned about?
The loanout's going to have to determine if they have a tax filing requirement. Some countries have separate sections of their revenue agency for the filmed entertainment industry, and they allow EPUS to submit taxes and use our annual reconciliation return as the tax return for the loanouts. I call these countries the one and done. One form gets filed by EP and the loan out is done with their tax and filing obligations. Other countries require the loan out to file a return within a certain amount of time after the filming is completed, maybe 30 to 60 days, and still other countries require an annual return to be filed on their tax year.
So what about the countries that require a loan out to file a corporate or a personal tax return?
You know, a great example is Australia. Australia requires a non-resident, including loanouts, working in the industry to file a tax return twice a year. When a country has a filing requirement like Australia does, sometimes the production will contract with a local CPA to facilitate the filing, especially if the filing is required as part of the film incentive.
Okay. Let's look at a longer example now. So let's say a US-based production is going to film for, say, 9 months in the same calendar year, and they're going to bring 6 actors and 10 crew.
Well, since they're going to be in the UK over the infamous 183 days, they could be subject to taxation backwards to day one, the day they got there. So the 183 days is not a, once you pass that threshold, now we're going to start. It's once you pass that threshold, everything backwards to day one is completely taxable in that location, and in this case, in the UK. So if a production is taking US-based crew to the UK, and they know for sure they're going to be there for over 183 days, we're going to continue all US-based taxes except for federal taxes. We're going to stop federal taxes, and we're going to start withholding for UK taxes, for UK income tax withholding. We're going to credit those taxes back on the invoice, and our colleagues in the UK would then remit those taxes.
I think this is like such a key point. Becky, would you mind just going into more detail about why the 183 days is so important?
It goes back to that definition of temporary. Tax treaties between two countries basically cover the employee that is sent to a foreign work location to work for a short amount of time. They're not relocating. Think of it, basically they're on a business trip. They are still residents of their home country. But if you stay longer than 183 days, you are now retroactively, you're now a tax resident, just a tax resident, potentially, of that foreign location. It's not applicable to all countries, but if we're just going to talk about the UK now says, hey, you've tripped over the 183 days. You're not covered by that temporary portion of the tax treaty, and now you are subject to withholding taxes here in the UK. So you don't have treaty protection after 183 days, and you're now subject to full employment taxation since the day you got there.
But you do get a tax credit against your US tax liability for the foreign taxation?
Yep, US citizens and permanent residents can take a tax credit for taxes paid in a foreign jurisdiction against the amount of taxes that they would owe on that same income here in the United States. They also potentially, if they go to a lower tax jurisdiction, they may owe taxes here in the United States because that tax credit wasn't enough to cover what they owed here in the United States.
And then I guess in terms of state withholding taxes, is there any double taxation there?
There isn't. States normally require withholding for their residents, so there is no offset for a state tax for foreign taxes paid. So you're going to pay either UK taxes, withholding, or IRS federal taxes, and then here in the United States, you'll still continue that additional state taxes.
So could you end up in a double taxation
You
position?
actually could end up in a, I'm glad you asked that. You could end up in a double taxation situation because in the UK, your withholding taxes are higher than ours. So in general, the wages earned by a US citizen or a resident alien working in a foreign country are subject to federal income tax withholding unless they can be excluded by IRS Code Section 911. And the way you qualify for that code section is you are physically out of the United States for longer than 330 days in any rolling 12-month period. So that individual that's working in a foreign jurisdiction between 183 days that's covered by the tax treaty and the 330 days that get you the exclusion here in the United States, that's the kind of the dead zone, if you will. That's the place where someone could end up in double taxation. In other words, they would be paying taxes in the foreign jurisdiction. They would still get that tax credit here in the United States, but because the UK has a higher tax rate, they wouldn't be able to use the full amount of what they paid in the UK against their United States income taxes. So if they had never left the United States, they would have paid, let's call it 22% in total effective tax rate. But in the UK, they may have paid 30% So that difference, that 8% difference, would be that what we would call a double taxation. So these exclusions that I mentioned, the 9/11 exclusions, they really require complete relocation. They include housing costs, and they're really when you hear the phrase expat, when someone becomes an expat. So basically, the rules were written for someone who is asked to move to a foreign location for 2 to 5 years and work at that foreign subsidiary, and that person plans on coming back to the United States after the assignment ends. So going back to our 9-month example, the employee could still take a foreign tax credit, but they either may owe federal taxes or they may be unable to use the full amount of the foreign taxes that they paid. In other words, the taxes that they paid in the UK may be more than what they owe in the United States. And you guys tell me, is the UK going to give them any of their taxes back?
Our taxation system isn't quite like the US. There aren't many ways to take that deduction back and, get a tax refund. But back to the depends. It depends on your personal situation. You may be able to get a refund, but again, it's a depends.
And then kind of Becky, back to you. What about Social
Mm.
Security?
To alleviate the burden of double Social Security taxation and to integrate coverage of employees, the U.S. government has entered into binational Social Security agreements, also known as totalization agreements, with many European countries, the UK, Australia, Brazil, Canada, Chile, Japan, South Korea, and Uruguay. Under a totalization agreement, expatriate employees working temporarily in the foreign country, generally up to 5 years, are subject to U.S. Social Security and Medicare taxes only. In order to have this agreement between the countries, the two countries' social programs need to be similar.
So how come only certain countries have a totalization agreement for Social Security?
The countries, like I mentioned, the countries have to have similar social programs. So, as an example, the US doesn't have a totalization agreement with Mexico or Argentina. In those countries, you'd have to look at their tax code, the written tax code, which is usually written in their language, to see if there's an exemption for temporary foreign workers.
That just sounds so complicated.
Yeah. And that, you bring up a really good point. It really is complicated, and that's why it's really important that our clients tell us where they might be filming as soon as possible, in case we have to research or update what we already know about a country, and in case we have to dig into that foreign tax code or confirm what the film incentive requires.
So for the countries that have a Social Security totalization agreement, do we need some sort of certificate of coverage?
Oh, darn it. The running theme for this show is it depends. A certificate of U.S. Social Security coverage is usually only required for someone that works in a country longer than that 183 days. If you know your production is going to be in the country longer than 183 days, we should get a certificate as soon as possible. It's just good to have, as many productions would hire FLB to ensure withholding taxes and personal tax returns were processed appropriately.
Yeah, this is very common. EP would pay that person, but the UK withholding taxes would be credited back on the invoice to the production.
Yeah. And then we at FLB can then work with the production or the relevant individuals to ensure their taxes are paid and the forms are filed.
Hey, I think we've covered as much as we can on that topic. Let's switch gears and talk about what a US-based client needs to know about setting up a payroll in the UK.
Well, yeah, I can take over. So the kind of key considerations for producing in the UK are one, setting up a UK SPV or special purpose vehicle or a UK company. Firstly, it's really important for the UK tax incentive, but also if you're kind of hiring in the UK, it's always a good suggestion. The second one is HMRC compliance, which is our taxation compliance. You need a few key different taxes to be compliant with. One is your annual reporting. You'll need your unique taxpayer reference for that, and that also kind of helps for any communications with HMRC. Second one is the VAT compliance, and that's done either monthly or quarterly, and obviously impacts payroll because a lot of payroll crew can be registered for VAT. And then importantly for this call, of course, is for payroll, you need to register as an employer with HMRC. So you get your PAYE reference, which can be done really easily online if you have a UK director. And if you have an overseas director, then it has to be done kind of communicating with HMRC on a call. And it's a bit of a longer process and you need a bit more information. Another point to consider is, of course, payroll software. HMRC has an RTI requirement, which means real-time information, and this needs to be really integrated as part of your payroll process. PAYE, as I mentioned earlier, the company needs to be registered for PAYE as soon as they start employing. And then some of the submissions that you need to make is an FPS, which is full payment submission. This needs to be done every time you pay your employees. And it includes the details of each employee's pay, any deductions, and any other relevant information. You need to complete employee payment summaries, EPSs, and these are kind of typically submitted at the end of each tax month. And it kind of where an employer discloses any reductions to their liability for their national insurance or any adjustments to the payroll. And then, of course, for the employees themselves, you need to be able to provide the kind of P60s, P45s, or P11Ds. So you kind of do a P60 and a P11D at the end of a tax year. That's kind of for more long-term employees, and then a P45 at the end of every employment, which gives you the details of your tax code. Another key thing to consider when employing people in the UK is the UK's pension requirements. It is set up for auto enrollment, so any eligible employees should be contributing to a pension. You can set up a pension deferral for up to 3 months, typically done by productions, obviously, because there is such short-term employment. But then, after 3 months, your employees get automatically kind of opted in unless they have chosen themselves to opt out. Another kind of key consideration for the UK, especially in film and television, is the IR35, or the kind of self-employment rules. In the UK, you can hire people via loan outs, via Schedule D, which is kind of looking after your own taxes and being self-employed, or via the PAYE, where the individual is taxed as source. Within the kind of grades of production, it is very much prescribed for production. You can't just opt to be either one of those taxations. You will be able to be loaned out if you're compliant with the UK guidelines on which film and television grades can be a loan out and look after their own taxes. Otherwise, most employees are PAYE, which means that the employer needs to look after their taxes and tax them at the source. Another key one to be mindful of is obviously the right to work checks. I'm sorry if I can go back. That IR35 as well is a employer responsibility. It's not up to the employee to decide, I want to be operating through a loan out company and I'll look after my own taxes. The onus of making sure that we are compliant with IR35 is an employer responsibility, which is why it is so important. And then, of course, the right to work checks, making sure that you can employ within the UK and the individual can work on your production. And also one to be mindful of is, of course, the UK unions, their rates and agreements, and what is the standard for, a fee, as well as the hours and how hours and timesheets are calculated. And this is normally where I give Kristy and the EP.
I was about to say, and this is normally where we start talking. So in the UK, EP has a compliant onboarding software called Production Portal. The portal allows you to securely onboard, contract, and manage your crew all from one platform. So that takes on some of the things that Chanchal was referencing in relation to the compliant onboarding of crew and being mindful of the rates and agreements that they need to have in place. The Production Portal is a secure onboarding platform and it's got built-in compliance checks. It also has a smart integrated timesheet module which reduces the payroll turnaround time, which is good for a production. And it's also in line with what Chanchal was talking about. It's got all those union rates in there, so it's completely compliant, and also making sure that you're paying your crew the rates that they are due to be paid. You can also send and track paperwork, contracts, NDAs, policies, right to work documents. So like Chanchal said, that making sure everybody has the right to work, and that's all done securely via the platform. There are also some amazing tools in there so they can help mitigate compliance risks. We've got a built-in IR35 warning flag. So again, like Chanchal said, the onus is on you as the employer to make sure that you're complying with IR35. So these flags will, you know, are in the dashboard and quite easily available to see if you are potentially at risk anywhere. The production portal's been used on over 200 plus high-end TV productions to date. It's very well used and very well liked. And we're currently in the process of just finalising our feature film agreements. So that should be ready come July 2023. So that kind of takes on all those compliance pieces for your contracting and your agreements. But in addition to the production portal, EP has an amazing payroll platform in here in the UK. It manages all of your payroll HMRC calculations and reporting requirements that Chanchal mentioned above, all of the real-time information, all of those individual forms that need to be sent to an individual like a P60 or a P45, that's all handled within the system. And then also in relation to the pension requirements that Chanchal mentioned, the auto-enrolment legislation, the system has that built into the platform too. So all of your pension auto-enrolment assessments and communications are built into the module.
An absolute dream, Kristy. We love using it.
Thanks.
I guess this conversation, we're focused on, you know, paying US citizens and US permanent residents when they work outside the US. So how can a production pay the pension, health and welfare to a US union like SAG, DGA, WGA if the US side of EP can't pay a foreigner working outside of the US?
Okay, we regularly have this scenario here in the UK, especially with the amount of TV and film production happening over here from the US studios inbound. We would be the main point of contact here in the UK. So for all your union payrolls, we would make sure we have all the information we need to be able to get that set up for you. And then we'll manage the payroll from the UK, processing the pay slips and the payment to the foreign worker. And then we work with our colleagues in New York to process the PH&W in a timely manner.
Great catch. You're absolutely right. Our paymasters in New York can make the pension, health, and welfare payment as long as they've received proof of payment and the start paperwork from our counterparts in the UK.
Oh, Becky and Kristy, thank you for such a great discussion today, and it's super reassuring to hear as a UK production accountant. Shall we review what we've covered and kind of best practice?
I think the most critical thing is that as soon as you know your production is going to go to the US, tell your EP account manager and send an email to taxsupport@ep.com. Give us as much information as you can, who is going, when, and for how long. And I just want to say thank you both for sharing your insights today. And let's check the Q&A. Natalie, do we have any questions from our audience?
We do. We got quite a few questions. Quickly, we got a few flurry when we started talking about the 183 days rule. So I just want to pull a couple.
Okay.
And we got a specific question about loanouts working less than 186 days, not required for UK tax obligation. Is that correct?
So it depends on if that loan out is in front of the camera or behind the camera. Because definitely in front of the camera, a loan out is going to have the 20% UK performer withholding.
Okay.
There are other countries, just as a side note, there are other countries that lump in not just in front of the camera, but they may also require the director or separately the stunt may be included or not included. And so you just really have to check. It's not uniform across all countries. And then you also have to double check the requirements for the film incentives in those jurisdictions.
Lots to think about. Okay,
Yeah,
thank you, Becky.
yeah.
And then as far as when the 183 days is considered to begin, is that by a calendar day? Is that number one day that you know, boots on the ground in the UK?
So glad.
When does that counting start?
first look at your airline ticket. And really, you know what, it's critical that you keep your airline tickets because it is boots on the ground, not when the plane left the United States, but when you actually physically got to the UK or to a foreign jurisdiction. They're going to start then. And it's, you know, a lot of people in the United States, because our tax year is from January to December, we think of everything in terms of a calendar year, but all of these treaties are just written with the words 183 days. So it's a rolling 12-month period. So you really have to understand if you're going to be there continuously. And some people would then say to me, well, what if I come home for a few weeks? And some countries would say, okay, that doesn't count for the 183 days. In fact, most would. Some will say, oh, you're coming back to work here and you just went to, let's say you're working in the UK and you went to Spain for the long weekend and then you came back. They're going to consider that those 3 days may still be in country. So if you're audited, uh, it's really important for you to have all the documentation that you can, and keep in mind it's passport control that's going to trip you up. If you're going in and out of a country frequently, you could get flagged. So so that's another area where I've seen people be surprised.
Thank you for the insider tips, Becky. That's really helpful. One last question about the 183-day rule. Is it advised if you know that you're going to be there more than 183 days to get set up with UK payroll from day one, or is it only something to worry about once you realize you're hitting that 183-day rule?
Yeah, that is a great question. And I'm so glad we're kind of taking a deep dive on it. If you think absolutely, positively, you're going to go over 183 days no matter what, you're going to want to just start that UK withholding day one. If there's a possibility that you are going to just come close, then we normally would say keep the US withholding, because here in the United States, we can pull back. We can pull back the federal withholding during the tax year, during our calendar year. We can pull it back from the IRS and we can move that money over to the UK as soon as you realize, okay, for sure, I'm going to go over 183 days. But if there's a possibility that you're going to hit 182 days, it's going to be very difficult. If we've started payroll on day one, it's going to be really difficult to pull that money back from the UK. And that's why I say it depends. And the last comment on this, I'll give you a real life example. We did have a production that was supposed to be out of the country. This is quite a few years ago, for over 183 days. And one of the leads in the production broke their leg. And we all know what happens then. Pause. And everybody came home for 6 weeks. And so it really threw everything into, so we have these surprises, and we're in one right now, right? We're in a strike zone. So there's always those surprises. You can feel and see the hesitation in my voice to say, you must be fully compliant day one, because I just know so many times that that we all went, we should have just, waited a little bit longer to make that change. So it's okay to go a few months and then, all right, we've got a cadence here. Let's go ahead and flip everybody and start the UK withholding and stop the IRS withholding, pull it back and get them caught up in the UK.
All right, great. I know that there's a lot to say about this, and I just want to give a quick plug to everybody watching. We do have a great article that Becky wrote on the EP website that covers a lot of foreign taxation considerations that production accountants need to be aware of. So head over and check out that article if you have any other questions about that. Okay, we're going to switch gears a little bit. We got a question, Becky, about kind of thinking ahead, knowing that you are working on production, your crew's going to be heading over to a foreign location, potentially the UK. What sort of questions should I anticipate getting from my crew if they're going to be heading outside of the US to a different location?
To quote a famous film, show me the money. No. So the first thing they're going to be concerned about is the per diem and housing, right? So be sure to figure out where they're going to be living, and then be sure to figure out what the per diem is for that location. So you can pay them their daily per diem. If you want to pay them more to entice them to go, that if you want to pay them more than the US allowable per diem, that's okay. But that incremental amount above what's allowable by the IRS code, we're going to tax as if it was income. So those are the main questions I get:
All right,
housing
great.
and per diem.
Okay. We also got a question because this did come up. What should we know about dealing with paying crew or talent who may be part of a U.S. union if they are working outside of the U.S.? So, Kristy, I'm going to pass that one over to you.
Thanks, Leslie. So to coin Becky's phrase of this webinar, it depends. We can manage all types of union payroll. I mean, from the UK all the way across to the US. So between the two countries, we've got you covered. There are lots of things. I would suggest getting in touch because there are variables like we mentioned earlier. When you've got a foreign worker who's being paid from the UK, then that's a different scenario in the sense that we have to pay them from the UK and provide the payslips to the ES for the PH&W. It also depends on whether they're above the line or if they're below the line crew in a union. So yeah, my suggestion is that to always seek advice from EP from either the US or the UK. Either will be able to help you.
All right.
So Natalie, I did notice in our Q&A, we've got quite a few questions, and I know we can't get to them all, but I know that we have a way of capturing those questions, and we can email those individuals directly, and we're happy to do that. So if we haven't answered your question from the Q&A, just know that you're going to be getting an email from one of us answering your question.
Yes, thank you, Becky. We do have to answer a few questions that are a little bit more specific to certain situations outside of the webinar. So if we did not get to your question today, yes, please know that we will follow up with you, and we appreciate every question that came through. So with that, I'm going to actually close out Q&A for today and thank everyone who submitted questions. Again, we appreciate that you engaged with us and joined the conversation, and thank you to our wonderful panelists for covering all of the great information that we covered today. So with that, I'm going to quickly remind everyone that because we covered so much today, we really encourage you to get in touch with us if you have questions. So if you are heading to the UK and you're in the US, first things first, contact your account manager immediately. Let them know that that change is coming. If you have any questions about production accounting or any of the information that Chanchal covered today, and any of our colleagues at FLB Accountants, you can get in touch by emailing them at enquiries@flb.co.uk. You can also drop us a line at ukhello@ep.com to get started with production payroll, the production portal, or any of our UK services. And if you have any burning tax questions that you just need an answer for, highly recommend that you reach out to Becky and our team of experts at taxsupport@ep.com. And with all the information that we covered today, we do want to let you know that you can always catch a replay of this session or any of the sessions from the Master Series at our website at ep.com/master series. We have our full library of webinars. I think we have over 80 webinars at this point, covering a wide range of topics, including industry news, product news, production incentives and financing, payroll and payroll tax compliance, as we discussed today, important legislation that may be changing in different jurisdictions, and we also have production and regional spotlights, so you can get to know a little bit more about where you may be headed or some names within the industry. Again, a special thank you to our panelists for joining us today and to our lovely audience. It was wonderful to have you. We hope that everyone stays safe and healthy, and we look forward to seeing you at our next Master Series.